Fantastic. So we've got Alex Tarhini, operating partner at Point72 Ventures. We've got Jimmy Fong, Chief Commercial Officer at SEON. And we have Martyn Holman, partner at Augmentum Fintech. Welcome to you all. Thank you so much for joining us.
Hello.
Hey. So, in the first 3 months of 2021 alone, over 100 fintech deals were completed in the UK. During that period, $2.9 billion was raised by fast growth fintechs, including the likes of Checkout.com and Starling Bank. So we're here today to explore how those kinds of deals were struck and how the entrepreneurs and management teams at these firms really stood above the rest and raised that capital. So let's go straight into some questions. So my first actually is for you, Alex. So why is fintech investment in the UK currently so strong, and is it going to last?
Yeah, I think it's definitely going to last. I mean, it's in the UK, but it's also global, right? And the UK is at the center of a lot of this, and so it's a bet, I think, on the entire space. So everything you just named, all those companies you just named, like really exciting stuff. You're seeing them, sort of. I think what you're seeing is investors and entrepreneurs kind of simultaneously with the customers themselves on the other side, all sort of realizing at the same time, like there's a lot to be done here. Core infrastructure needs to change the way, at the large banks. And then you have the Monzos and the Revoluts of the world that are sort of attacking them from the other side. And you're seeing massive growth from them. And so, there's just like a whole sort of white space for the entire industry to be pushing forward. And London happens to be at sort of the center of a lot of this.
Fantastic.
Yeah.
And let's talk about the last 18 months of uncertainty during a pandemic. Martyn, coming to you, how has that kind of uncertainty in the last kind of 16, 17 months impacted investment into fintech?
Just to pick up on, also on that last question there, I mean, these things are always, they're always network effects. So, we've got sitting in the very hard financial centre of London. It's something that's been built over several decades. London being the centre of sort of financial innovation in Europe, and those networks are now starting to compound, I think. So that's kind of why London is at the heart of European fintech. And I think if you look back to what's happened over the last 18 months in terms of exemplifying some of those trends, trend to automation, trend to remote purchasing, all of the less use of cash. I mean, all of the trends that have kind of been pushed by the pandemic have kind of accelerated the winds of change of fintech. And we've seen, a massive influx of capital into the space over the last 18 months. Certainly, if you look across, a lot of our portfolio companies have benefited enormously from some of the changes. And I think, that those two factors compounded, the network effect of being here in London, an influx of US capital, and a reinforcement of the trends that surround fintech mean we've reached the sort of strength of position that we're at.
Brilliant. And Jimmy, you raised your Series A earlier this year. Can you tell us a bit about your experience of raising during a pandemic?
Yeah, absolutely. So we raised, I would like to say contextually, we raised a fairly modest Series A, 10 million euros, and we announced it publicly in March. So for us, we're twinned out of Budapest in Hungary and also London here. But to kind of extend some of these thoughts, I think the move for COVID for us was about a move to efficiency for a lot of companies when we just collectively recognized that remote works. It happens, it's fine. And it accelerated so many things digitally. So for us that provide fraud detection and modular APIs to help microservices, if you like, I think this forced an adoption of, actually, we don't need to use the already developed providers in that space, which have done a great job. And they've been around a very long time, 15, 20 years since e-com ever existed. So for us, raising capital, I think was unique because being twinned out of Budapest, where 90% of our colleagues are, it's an amazing place for engineering talent. We're a tech company, so that's a big focus for us in AI and machine learning. It really pushed out for us a focus that we ran already a very good OpEx operation as a result. So OpEx efficiency plus hovering around profitability ever since 2019. We were live kind of mid-2017. Kind of changed the dynamics of raising finance. I think it already changed the dynamics in a normal world, but given a COVID world where I think there was influx of capital, focus on efficiency, it kind of made the conversation very, very easy from that standpoint. So we went live or active into having discussions at the end of last year for entertaining a Series A, and in a number of weeks we were multiple term sheet offered at that stage. So that was very efficient from our side, but that's based on, I think, running a good ship first and foremost.
And did you actually get to meet your investors in person, or was it all virtual?
It's all virtual.
Right, and which is also a big change in itself, because I think historically, the kind of investor relationship has always been in person, building those relationships.
I mean, I think that's a change that's here to stay, actually. And in venture capital, charging off to Berlin or Helsinki or Madrid to meet a company for the first time. I mean, sure, you're only going to do that selectively as a venture fund to those that kind of meet the baseline criteria of what you're looking for. I'm sure we'll talk about that a little more in a bit. But still, it seems kind of wasteful. So meeting a team, particularly when they're not here in London, via Zoom, it feels like a natural thing now, and the messages, the body language, the unsaid things can still be translated through Zoom in a way that's very close to the real one-to-one situation. We've made several investments over this period without having physically met the team. So I think that is a positive impact, because it reduces the amount of travel and increases the amount of time that you have, because you're not wasting it sitting on a plane.
And just to add to that, I remember from our experience of doing this, where we were making those initial kind of meetings with kind of VCs. It put the focus on what it should be, right?
Exactly.
About the efficiency of a business, take the emotion out of it, and let's see how effective it runs. So whether you're looking at the unit economics, the trend, but also on the flip side for that VC, it cuts out the BS and it forces you to kind of go, right, Alex, what can you actually help us with? Give us real examples. And all that kind of like the beer chats and stuff, that's cool and that'll come, but I would say it makes you focused in on, does this work for both parties? And I think that's a good thing as well.
Yeah, you're kind of dragged into the subject, aren't you? Because it's like there on the screen. You're not chit-chatting across the table.
Brilliant. And so let's move from an investor perspective, what you're actually what you really look for when you do meet a prospective company. What's the kind of first thing you're keen to understand? Perhaps Alex?
Yeah, so for us, I mean, we're super focused on, on three main areas, I think, across financial services. So enabling, embedding, and disrupting. So enabling the actual incumbents themselves to be able to compete with the Monzos of the world. And so we'll go and spend a ton of time with the actual people that are building these products and making the decision makers, building these product roadmaps and asking them, hey, what's next for you? What are you thinking? What are your biggest pain points? And then going and finding those solutions. You could say the same across the board. So embed, so the actual companies that are building the infrastructure to allow embedded financial services to happen. And then, on the flip side of that, what are the new sort of ways we're going to be interacting with financial services in the future? And then finally disrupt, so the actual folks that are disrupting the incumbents themselves. So what we do is we'll go and we'll come up with a thesis based on, extensive amounts of calls and research and, relationships that we're building with the folks that are actually buying and building using these fintechs. And then finally, at the end of that, we're going to go look for a solution. And so for us, it's a bit more of almost outbound, like us going and looking for a solution to a problem that we've identified, versus sort of sitting back and waiting for companies to come to us and saying, hey, what's your revenue? What does your growth rate look like? What does your profitability look like over X amount of years? These things are important. Unit economics are important. Management team's important. But for us, it's all about like actually understanding the market, actually deeply understanding the pain point, and then going and finding the right solution for that. And so, for us, it's almost like we tend to know what we're looking for before the company comes to us. And so, we like to think that we should be putting in that work if we expect to partner with entrepreneurs.
I think that's right. I think most venture funds will have an active thesis in a market area and will be selecting the companies that they want to meet as much as the companies, as much as propositions coming to them. And if you think, just to expand a little bit more on Alex's point there on the generics, I mean, there are three real questions. I mean, is there a substantial global market for the beachhead application of the product, let alone the further applications of any individual product. Can we see this getting, for the first arbitrary point of argument, can you see this getting to $100 million without taking outsized market share in the market in which it's operating? And if there isn't an existing market for that, is there a compelling reason for why that market will develop? And then secondly, is there clear value proposition around that? Can you neatly describe that value proposition? Is it sustainable? Is it scalable? And then thirdly, the team that's addressing it, are they credible? Do they have the drive and the motivation that's required to succeed? I mean, at the early stage, it's about that. Then as they migrate through, at Series B and Series C, you start looking at some of the other factors that Alex was talking about in terms of, growth metrics, unit economics, and all the nice things that go along with that.
And Jimmy, maybe you can tell us a bit about how you found your investors, both for your Series A and perhaps for the seed round that you raised in, I think it was 2018, but also what kind of challenges you faced along the way.
Yeah, so you're talking about outbound and inbound there. So our whole SaaS business is inbound. It's like 90%, that's where our rev comes from. And I would say the same, funnily enough, existed on the fundraising side of things. We were approached by very, very decent kind of outbound efforts from a bunch. And I think for us, like hopefully any good tech company, you're focused on build. That's really the main thing. Capital raising isn't the name of the game for us. It's like a side effect. So we were, heavily inbound from VCs in that sense. And we were able to, kind of hold conversations that was relevant to us, where we could actually have a credible use of that capital, where it could accelerate what we're trying to do in terms of experiments. That's kind of how we looked at it. So I would say even now, where we're at A stage, we're just recently A stage. Mm-hmm. The name of a game for us to the next stage, and we talk about this internally, even within our startup. We hate talking about these capital events as like the end goal. It's just a proxy to where we are as a stage and company. Yeah. So for us, it's around repeatability at this stage. We're starting to define some things that work in terms of a go-to-market motion. We're starting to get understanding of unit economics. Still a lot of muddiness out there, but we're trying to do our best to define repeatability is what we're doing. And at that stage, when you're having, I think, those kind of discussions internally, I think the discussions from a fundraising point of view are super easy as far as I'm concerned, because that's what these guys are wanting to do. They're trying to find people, maybe to Martyn's point, that are conscious of this. There's a lot more value they can add, but at the same time, this has to come from that team, the business itself. So I would say, kind of focus on those kind of things that makes the conversation a lot easier from a VC fundraising discussion point of view.
And what would you say your biggest challenge was in raising this year?
There was probably, because, we were very lucky that, we had a lot of inbound. So I think for us, it was actually internally defining as a small team what was actually important to us from that relationship, right? It's not the capital, clearly, but what else can we get that's intangible? And more importantly, how can we test that potential VC pre-commitment on both sides? And what I mean by that, the example for us was, because we run things so efficiently, we knew we could stretch out a runway for so long. But what we wanted to do, when we lack this, is we're so bottom up in our go-to-market. So it's the end user that discovers us and starts getting value from us, that we lack in our traditional space, that top-down go-to-market. So people knowing people at CX level of this cool bank and this cool fintech. So we actually recognized that we needed from an external partner's point of view, that's what they can bring to the table straight away for us. And for us, in our discussions, it was super fun because everyone talks about that's the value they can add. But what we really judged our partners when they were speaking to us on was, right, how many conversations can you start to facilitate? It works. It kind of works for both parties because the funding partners get validation from people that are credible within their portfolio, of course. But then it also works well for us. So we're very conscious on that tangible output. If we're going to invest time even opening the door and having that value discussion, then we kind of wanted like an immediate takeaway. So the hardest thing was almost coming to that point and recognizing, it's very flattering to get approached by, some really awesome names. But the important thing is, that's not our main role. Our main role is to build, hopefully, great product.
And I think that dynamic has changed quite substantially in the last couple of years, actually. I mean, it's always been a two-way sell. You know, there's kind of a marriage happening. You're bringing on a new owner of the business as an entrepreneur. But you know, typically, you know, certainly if you go back 10 years, it's, you know, we are the venture capital firm. You're coming begging to us, and you need to prove to us why we're going to invest in your company. And I think that dynamic has healthily changed. And you know, particularly in the last 12 to 18 months, with you know large, you know, Europe being now recognised as a second home for American venture capital. You know, significant amounts of capital coming into the space from various sources. Now very competitive to get into the best deals, and you've got to be proactive in that outreach. You've got to develop those relationships, and in the course of you know, negotiating agreements with, you know, companies like SEON, you need to be bringing the value, you know, bringing the value that you can to the table and demonstrating it up front, rather than relying on signing the deal and then bringing a few things along later, which was the old dynamic. So yeah, I think, you know, things have definitely changed.
And Martyn, when we think about the kind of the businesses and the CEOs that you're working with when they are looking for investment, do you identify any kind of common, perhaps, mistakes that some CEOs may make when they are kind of proactively looking for investment?
Yeah, I mean, yeah, I think, you know, that there's the kind of generic advice about, you know, the pitching process, and you know, being brief on details and expanding with a pyramid process. So you know, I think it's important from an investor perspective. If you haven't got the proposition in the first, you know, couple of minutes of the discussion, you can't develop the conversation base in the way that you need to make it a credible investment. So there's definitely something over brevity, over detail in the first instances of what you're doing. But I think, again, that also has changed because, you know, with more active outreach, it's often, you know, the investor will already know all about the business, and you need to dig further. I think, you know, identifying, as Alex was saying there, in terms of being able to, you know, define what the right shape of the investor that you're bringing to the table is very important. And you know, there are examples of where you brought the wrong investor to the table, and the relationship sours. But you know, I think these things are all kind of generic things rather than specifics about those types of engagements.
And do you still, I know obviously both of you are very proactive in reaching out to companies that you're looking to invest in, but do you still get a lot of kind of pitch decks directly to you? And if so, is there something that specifically gets those standing out?
Yeah, I think most VCs now are very open about their thesis and what they're most interested in, and you know, their sort of sweet spot. And so, like, if I get an inbound, which we actually have made investments off of cold inbounds before, just because it was like so clearly right up our alley and something that we were really interested in at the moment. So if you craft the right message and you know find the right person at the fund, you know, at least I would absolutely take that seriously. I mean, if it's checking boxes for me, then I'm going to get excited about it.
Are there any kind of conversation closers in a way on a pitch deck? If you see something you just kind of think that's not something that we would go for?
I'm sure we've all seen a lot of really funny decks before, but I don't know, Martyn, if you have a good example.
Yeah, I mean, I think. I mean, I talked before about the three important things. I mean, where a team doesn't really understand the market opportunity that they're driving at, or really understand the constraints that are on venture investors to be investing in companies that are capable of returning the fund effectively, then that's kind of an instant turn off, because you haven't really targeted your approach correctly. You know, I think often. You know, decks that come dense with detail, like some kind of management presentation. You know, you're not presenting to your audience in the right kind of way. We're a dedicated fintech investor, so obviously anything that comes that isn't fintech is obviously immediately out of the door. So about understanding the audience that you're presenting to.
Yeah, I would add one more thing, at least in the conversation side of things, once maybe you've moved past the pitch deck, it feels like just with the market that's so hot right now and investors, so excited to play in the fintech space, and there's hot themes that within that. I think founders know this, and obviously, and in a lot of ways, it's great, and in some ways, it feels like some founders might sort of use it aggressively to sort of like play a game, amongst investors, which is actually like something you should do to an extent. But it's when it kind of goes a little bit too far where you're like, well, we're not really talking about the business anymore. We're mostly just talking about the investment, and I haven't got to know the company very well yet. And so we have some instances like that where I'll personally get turned off, and I'm like, this is probably going to end up becoming a massive business because this CEO just knows how to sell really well. But I need to get really into the company, and I need to really understand what we're partnering on and investing in. These are, 5-10-year relationships plus. I'm not in it to just like quickly get in and out of a company. It's a deep relationship and partnership, and so I want to get into like the guts of the company and where you're going forward from here and things like that. Less so how fast are we going to be able to close this? I just met you 30 minutes ago, that kind of thing. So.
But just to chip in there as well, clearly this exists, and it's partly because of this market condition at the moment. It's in a space where it is competitive. So we actually had in our practical kind of situation, we were very lucky and very fortunate and very humble to have a number of term sheets to us. And actually the one we went with at the end came in super late via Angel Connection, and they blew us away with, it was as much that they knew exactly what we needed in that relationship. So those top-down investments, like right after the session, we were straight on to founders over at Spotify, et cetera, and that's exactly what we needed. So it can happen like that as well. And despite us not having that virtual Zoom time with them, where we had with a number of other partners, like their actions spoke way louder than the words. So I think on the flip side, on the company side as well, important to mention that it is definitely a mid to long-term relationship. So you need that trust and human factor, but it's also, to keep in relative terms, it's at different stages, right? It's that for us, it's the A stage, getting into A, but knowing would be adding in more and more members to our board. Touch wood, that's as we grow healthily, that's what we want. So it's knowing it's also transitory as well, and I think that there's a balanced side of things to that.
And so how did you kind of, I guess for people in the audience, just as kind of some advice, but how did you prepare for those conversations with investors? And did you do a bit of kind of due diligence yourself in terms of who you wanted to approach? Or how did that process work?
Yeah, it was a little bit different for us. It was very one-sided on our side. But like anything, you don't want to walk into something cold. The better prepared you are, clearly the better use of that time. So for us, DD was massive. So reaching out to folk we knew in common. We went out cold actually, as we got to a decision point, went out cold to their portfolio company. If we didn't know anyone, then we went out cold nonetheless to their founders. And founders are very happy speaking to other founders about how these guys are. So that was really helpful. So I would say that at a minimum,
Brilliant. And Martyn, perhaps you can share with us what the process is when you kind of do speak to a founder about a company that you're interested in investing. What does that kind of process look like? How long does it take, typically?
That's an interesting question, because I think that has changed quite radically as well. Traditionally, I think a well-prepared entrepreneur, a well-prepared company will start those discussions well in advance of when they need to raise the capital. I mean, the worst time to raise capital is when you need it, and the best time is obviously when you don't. The flip side of that. So I think well-prepared companies are having those discussions and developing those relationships, either with and through their existing investors or through their existing network. Probably 3 to 6 to 9 months ahead of certainly of where they would not want to start that process were they to leave it to the moment that they need capital. I mean, it gives you a much greater leverage, a much greater negotiating position to be able to do that. And often, we talk to companies and they say, well, we're not raising at the moment. Of course, loss-making companies are always raising and always thinking about the next milestone. But that's code for actually, if we want to get into a discussion here, the valuation's going to be a little bit higher than you might otherwise consider. So I think you overlay that. You overlay that piece. Then when you are into an active, competitive fundraising discussion. Obviously, you'll have the first meeting. You'll generate interest around that. You'll start to collect some, internal due diligence. You'll reach out to people in your own network. Some back channel referencing. You come to a decision around your investment committee around whether you want to take this forward to the next stage. You then get to a term sheet position. You'll sign the term sheet. And then you'll engage in the completion due diligence and all of the legal process around that. So, traditionally that kind of first meeting to term sheet would have taken quite a long period of time. But we've had experiences in this last 6 months where we've made that in a small number of weeks, and I think increasingly around the competitive round and interesting companies, you need to move that quickly. And as I say, if you've developed a relationship with a company, you've had discussions with them as an investor at the appropriate time. You've got to know them a little bit better, and you have an active thesis in that space. So you've ruled out the kind of market due diligence piece because you've done that up front. It is possible to make those decisions a lot more quickly.
Alex, how has it changed for you? Have you noticed a speed up in the process over the last 12 months?
Yeah, absolutely. I mean, I agree with everything Martyn just said. I think he put it really well. If you're ahead when it comes to the relationship building with that founder and then with understanding their market, you should actually be able to move pretty fast. Not 2 days fast, at least for me, but 2 weeks is possible. And so we've definitely cut our, and just looked for ways where we can be more effective and efficient on our side, which I think we should do. I mean, there's an extreme, again, on the 2-day side of things, but we should also, if we're asking companies to move quickly, go to market, test their product, pivot, do all these things, we should be doing that as investors on our side. We should be using technology. We should be thinking of gutting our inefficiencies, thinking about our process, really, I mean, we do that a lot. I think we're constantly at Point72, like a lot of the junior team hates it because we're always like, okay, we're back to the drawing board. Let's rethink our process and ask ourselves, how can we make it more efficient and effective? So yeah, the market is absolutely pushing us to do this now and do it faster at the moment. But it's on both sides of the table, and so I think it's a good and healthy thing.
I think that's a hard point for venture investors, actually, because on the process, you asked about the process, and Alex just mentioned it there. There is no standard process. Every deal is bespoke, and yet you're trying to fit this pro forma approach to it in a private equity type of way, and it just doesn't fit because every deal is a deal itself. So we're always constantly looking at the process, thinking, how do we improve this?
And Jimmy, coming to you, so what kind of I guess if you were going to give advice to someone in the audience who was looking to pitch for the first time to an investor, what kind of advice would you give them?
I think kind of a lot of these concepts have been discussed, but I would say know your customer is massive. So for us, we're massively product-led and we're overly product nerdy, I would say. And so we have deep tech knowledge about this, but we recognize for that audience, if we're talking about what our grander mission is, it's completely irrelevant to dive into those details. So I would say, the basics of just being relevant to the people that you're about to share time with is massive. This can all be prepped in advance. I would say, even if you're being inbound as a company from a VC, whoever is inbounding you, it's in their interest to look good in front of the rest of their decision team as well. So they should definitely be your coach on this. What do these senior partners really want to focus in on? What do they care about? What's their personality like? All of this can be prepped in advance from a first pitch point of view. And then back to a concept you talked about earlier, prep. All of this stuff is pretty out there, to be fair. So their LinkedIn profiles are available, their interests, their background, their what made them up in their career, where they're influenced, where did they cut their teeth? All of this matters when you're in that pitch. But I would only do this if it makes sense, right? So as in you've presumably vetted them as well, that they add enough value, and whatever that decision criteria is, their portfolio is very complementary to you. They bring in domain expertise that can add value. And actually, I was just going to say this, it came to me just as we were talking a bit earlier. I would say the other way that VCs are changing, which I think is awesome, is it's a slightly different thing. There's a recognition, it's not about the capital, but it's about the willingness of value. And for us, we're finding this, and it's partly down to how we go to market as well. It's around giving content to our target buyer audience, and that's how we interact with brands. So it's adding value before you even have a commercial relationship. And for us, so we go under a moniker of product-led growth is our GTM, our go-to-market. And for us, there's actually, I'm not going to call them out, but there's really good VCs that's actually how they lead. They push out content that is world-class in that domain. And that makes us, even though we have no commercial relationship with them, but that's when they enter into our consciousness as well. Mm-hmm. So I think that move is also very healthy, is where, the brand VC adds value in other ways, which could be very niche, but for that niche, it's going to really resonate as well. So I would say, the kind of pitch stuff, kind of the concepts we talked about, but I would say that the dynamic is very different if you're also very guarded over where you spend your time, which I think is a good thing for both parties as well. I mean, Alex said it, the really good VCs, they've already got a thesis, they're convicted, and they're almost looking for weird ways that you're not going to tick those boxes. And there's a lot of stuff that you can see in black and white that just proves that thesis. Depends how early stage you go, I guess. But yeah.
Brilliant, thank you. And any additional kind of pieces of advice from you, Alex or Martyn, just to follow on from that?
Yeah, I mean, I think, in terms of, we talked a lot about, that kind of connection between entrepreneur and venture capital and this term of adding value, which, is an amorphous term and is interpreted in different ways. I mean, I think at the end of the day, it is also down to a personal connection. It's down to the chemistry that's driven in that first meeting between the entrepreneur and the investor. The entrepreneur will have done all of the research that Jimmy was talking about there in terms of going away and looking at interests and past experience. But if you don't get that connection during that first meeting, then you're unlikely to be the chosen investment firm. Yes, there's something about brand, and brand is about the portfolio you've built as a venture capital portfolio. But it's down to the individuals within that firm to drive those investments.
Fantastic. Well, let's now kind of move to looking to the future, I guess, as the kind of last 10 minutes of this session. Alex, coming to you. So how do you expect kind of, I guess, the fintech sector more broadly to evolve over coming years, I guess? And any ambitious entrepreneurs, what should they be looking for to exploit that?
There's so much white space still left. It feels like there's a lot of hype right now, but if you look under the surface, there's actually still a lot to do. Especially if you have a global lens. But I think UK and Europe, there's immense opportunity just here. For us, it's those three areas I mentioned before. I mean, I should probably say also as investors, we focus on seed to Series B. Again, the enablement, the disruption of financial services, and the ability to embed those financial services. So those are like the sort of highest level areas. Me, I'm really interested in e-commerce and the sort of infrastructure layer around that. Everything from like fulfillment to payment at the end of things. Commercial and corporate banking, I think there's so much white space there. We've made a few investments in this space, but I think there's still a lot more to do. There's trillions of dollars in that system, in that part of the financial system that's extremely inefficient. If you just think of like any big multinational company and what their ERP system looks like, and how payments are going in and out of that, there's huge opportunity there, I think. So if I'm an entrepreneur, I'm looking in that space for sure. I think ESG is obviously something that's really big right now and in top of mind. And there's a lot of, again, I'm pretty biased towards infrastructure, so I think there's a lot of infrastructure to be built there. I think those are like the big areas for me.
And Martyn, obviously very fintech focused. How do you think the kind of Augmentum portfolio will diversify moving forward?
It already has to some certain extent. I mean, we talked last year about Fintech 1.0 being kind of a wave of disruption of consumer-facing, largely the neobanks sort of five years ago, coming in and making better models of distribution and better UI and better user experiences for small daily problems that became a big problem as they mounted up over time, and that's where that first wave of disruption came from. And this sort of second layer of disruption now coming through, which is kind of at the mid layer with big data and AI and various applications, helping automate and increase efficiency and drive forward those first wave into more mass application audiences. Alex talked there about embedding of financial services, and I think inherently what that means is disaggregation of the layers of the service provision. So increasingly you see point applications in various value chains, whether it's banking as a service now not being whole suite platforms, but actually specific parts of that value chain, or other layers of other industries like B2B applications in InsurTech, which facilitate existing liquidity pools rather than just being InsurTechs going out there delivering a new model of an MGA that gives better distribution for motor insurance, which is not innovative in any way. So I think increasingly you see more aggregation of the opportunities in the second wave. So there's that. There's a kind of the breaking down of the various sort of value stacks, and then you've got whole new waves. So at Augmentum, one of our theses is definitely around the crypto space and blockchain. We think we're past the point of no return some time ago now for the inflows of institutional capital. So the institutionalization of the crypto space. Largely around infrastructure that's there to support that, and recently made an investment which supports that proposition. So yeah, I think those are a couple of the trends. Yeah.
Brilliant.
And if I can add actually, so I'm not a VC obviously, but we play into some of these macro trends as well. And I would say the two for us, which is I guess linked to Alex and Martyn here, is first of all around the whole B2C is B2B. That's the reality. So the bar is so high for everyone in B2B because we are intrinsically trained, right? When we consume Netflix, Spotify, etc., the UXs, all that experiential stuff is so high that I think the best SaaS companies are tapping into that. It's no longer acceptable for an enterprise-only model where you literally connect on that and that's it. That's gone nowadays. The best SaaS companies, which are B2B, recognize this intuitively. So everything from onboarding, and I mean this as a B2B provider, onboarding through to kind of how you're looked after from customer success is so high. I think the best SaaS companies intuitively practice this. The other big trend that we feed into as well is around interoperability. So it's around microservices and no longer being reliant, I think, on platforms. It's this ability to tap into expertise at a whim on that microservice. And I think for our world of fraud detect and authentication, that's like a big macro trend that we tap into as well.
And Jimmy, what's next for SEON? More investment on the horizon?
So that's a good thing. We're working with a tier one VC as they push you even more aggressively. And we actually face the real challenge of just speaking very openly about this is where we run efficiently, so we find it hard to deploy fast enough. And we've gone, just to give you an idea, we've gone from 18 people in March last year, COVID time, to just over 100. So it's not like we're slow. We're just we just can't deploy it quick enough. And so we actually face a pragmatic thing of, man, what would we do with another 50 at this stage, quite frankly? And when we are having those light discussions, that's a question we're genuinely asking because we feel like we're still muddy around repeatability, and we don't want to go ahead and roll that out until we have a certain amount of certainty. It doesn't have to be 90%, but it has to be pretty certain around repeatability. So just speaking very openly, we're build mode as an engineering company, but we face a philosophical challenge of what the heck would we do with that?
Well, I look forward to seeing how it continues. And a final question that I have for each of you is just what are you excited about in the next couple of years in the fintech scene or wider?
Well, I'll just add to what I was saying earlier. I skipped a couple of themes. I agree with Martyn on crypto. It's a big one for us as well. Now we're starting to finally make some investments there. And then another big area that I'm excited about, the self-employed and gig economy. There's so much, that space is massive right now. I mean, if you just look around London and you see Deliveroo and Gorillas and all these new companies coming out, these are people that are self-employed that don't really have the benefits layer and that you'll have as a full-time worker. And so there's a lot to be done there from taxes to just traditional benefits that should be offered to these folks to feel more like a full-time employee. So that's another space I'm super excited about. And then just broadly, I just landed here in London a couple months ago, so I'm really excited to really sink my teeth into the space here locally, and hopefully as soon as flights are more open, be moving around Europe more freely and seeing what else is out there. It's a fascinating time, I think, to be in the space. Yeah.
Martyn, what's exciting for you?
Yeah, I think just more generally, I'm excited about the portfolio that we've got at Augmentum, developing that portfolio, and deploying further swathes of capital. We just recently raised further capital into our listed market structure. The permanent capital model, I believe, has distinct advantages for venture in removing the sort of time element from a number of the components, increasing the spread of investments that you can make from early stage and being very patient all the way through to pre-IPO without damaging overall fund returns, which would happen in a normal GPLP fund. So yeah, I'm just really excited about the position that we built for ourselves at Augmentum, the brand that we're growing and furthering that journey really in the next 2 years.
Brilliant. And Jimmy, what are you excited for?
So the FT released an article this morning around fraud levels at all-time high. The UK government earlier this year stated and raised the profile of online fraud at national security risk level. That's unprecedented. So the flip side is with digitalization and the move, there's very clever fraudsters that take advantage of that. I would say for SEON, the rest of this year, we're fixed on helping that long tail of smaller merchant that's been forced online, but doesn't have tools to help them at the same time protect against fraud. So our developments, our R&D efforts, our engineering efforts for the rest of the year are around connecting up to the long tail retail platforms. So at a click, you can get even quicker. At the moment, we talk about 30 seconds you can be up and running with our tech, but what we want to say is in 5 seconds you can be up and running with our tech. So that's what we're excited about, helping that long tail of the market, which is critically underserved.
Great. Well, I think that's our time up. But I want to say a massive thank you, Alex, Jimmy, and Martyn, for joining us today. Thank you all for being here and tuning in online as well. And you've got more coming up next. So thank you very much.
Thank you.
Thanks.